Monday market. The week right after Christmas, silver crashes 10%. Volatility unseen before. Social media explodes with claims of a systematically important bank failing, and you should smash the sell button and brace for impact. Look, if you're short on time, or you don't want to listen to some random guy on the internet with a cat theme going on, here's my thesis. I pulled the actual Fed data. The story falls apart. The silver crash was caused by a CME margin hike liquidating over-leveraged longs, not a bank failure. While the year-end liquidity tightness is real, it's seasonal, not systemic. That's the takeaway. Now, if you want to understand why this matters and how to actually read Fed data so you don't fall for the next viral panic, stick around for the next 10 minutes. So, a quick introduction for anyone new here. I'm DataCat. Yes, the name is exactly what it sounds like. I like data and I like cats. Cats are honest creatures, you know. They'll knock your stuff off the table and stare you dead in the eye while doing it. No pretense. That's kind of my approach to financial analysis, just without the property destruction, usually. I hope. I spent years as an analyst inside a Fortune 50 company, crunched numbers, built models, sat through meetings that could have been one Slack message. The whole corporate experience. About 5 months ago, I traded all that for a keyboard and the freedom to actually say what I think without running it through 3 layers of compliance. The channel's still tiny. I'm not going to pretend otherwise. I'm an introvert. Self-promotion feels weird to me. But I figured if I can help even a handful of people cut through the noise and actually understand what's happening in markets, that's worth doing. So yeah, if you're into this kind of content, please hit that like and subscribe button so that my cat and I won't end up homeless. Now, enough with that. Let's get into what actually happened with silver on Monday. Alright, for those who are unfamiliar with the commodity market, December 2025, silver had been on an absolute tear. We're talking prices touching all-time highs. The precious metals crowd was euphoric. Reddit threads were celebrating. X was full of rocket emojis. And then right after Christmas, it all came crashing down. Over 10% drop in a single session. Now when something like that happens, people want answers. And honestly, that's reasonable. A 10% move in a major commodity in one day is violent. Someone got hurt. The question is, who and why? Within hours, a narrative started spreading, and I mean spreading fast. The claim went something like this. A systemically important bank, one of the big ones, had massive short positions in silver. The rally forced a margin call they couldn't meet. The bank was about to default. So the Federal Reserve on a Sunday secretly injected $34 billion through its repo facility to prevent a cascade. Sounds dramatic, right? Almost like a financial thriller. The kind of story that makes you feel like you're getting insider knowledge that Wall Street doesn't want you to know. Yeah, I know. We content creators often use this kind of tricks for your attention. And here's the problem. When you actually look at the data, the boring publicly available Fed transaction records, the story doesn't hold up, like, at all. Let me walk you through it piece by piece. And yes, I'll explain every term as we go. Because, frankly, the financial industry loves making simple concepts sound complicated. It's like cats acting like they don't want attention, and then sitting directly on your keyboard. The behavior doesn't match the stated preference. So let's start with the crash itself. Why did silver actually drop? The rumor claims a bank's short position blew up, forcing liquidation. But here's the thing. If a bank with a massive short position failed, that would typically cause prices to spike, not crash. When you're short, you eventually have to buy to close your position. A forced short cover creates buying pressure. The price went down hard. That tells us the opposite was happening. Longs were selling, and we have the smoking gun for why. The CME Notice 25-393, the CME Group, that's the world's largest derivatives marketplace, issued this notice on Monday. Due to extreme volatility, they raised the initial margin requirement for March 2026 silver futures from $22,000 to $25,000 per contract. Let me break down what that means in plain English. When you trade futures, you don't pay the full value of the contract up front. You post margin, essentially a good faith deposit. It's like a security deposit on an apartment, except your landlord can change the amount whenever they want based on how risky they think you are. The CME looked at how wild silver was trading and said, effectively, everyone needs to post $3,000 more per contract, immediately. Now imagine you're a leveraged trader. You've got, say, 100 contracts. Suddenly you need to come up with $300,000 in additional collateral. Today, during the holidays. when banks are running skeleton crews and liquidity is already thin. What do you do if you can't wire that money fast enough? You sell. You close the position to meet the margin call. And when everyone in that situation sells at once, prices collapse. The falling price triggers more margin calls for other traders. They sell, prices fall more. It's a simple feedback loop. This is called a long squeeze, and it explains the entire move without requiring a single bank failure. The timing matches perfectly. The margin hike was announced, and boom, flush. All those over-leveraged bulls got taken to the woodshed. Okay, but what about the $34 billion? What about the Sunday injection? This is where the rumor gets really sloppy. I pulled the New York Fed's open market operations data for the period around December 29th. Here's what actually happened. First, there was no Sunday operation. 0. Fed repo operations happen on business days. The idea of an emergency Sunday injection is frankly made up. Second, on Monday, December 29th, a normal business day, the Fed did conduct repo operations. Here are the actual numbers. Overnight repo purchases, $16 billion in treasuries, about $26 billion total, including mortgage-backed securities. The Fed also conducted overnight reverse repo of about $10.5 billion. So where does $34 billion come from? My best guess is someone either added these numbers together incorrectly, combined multiple days, or just rounded up for dramatic effect. But here's the crucial context. Let's assume it's true. Someone actually knows something. A $34 or $26 billion repo operation in late December is not unusual. It's just seasonal. Every year-end, banks hoard cash. Why? Regulatory reporting. They need to show strong balance sheets for their GSIB calculations. This creates a temporary cash shortage in the interbank market. Dealers who need short-term funding go to the Fed's repo facility because private market rates get expensive. If this were a genuine emergency bailout of a major bank, we'd see much larger numbers. We'd see spikes in overnight primary credit. That's the real emergency facility. We'd probably see announcements of special facilities. We'd see news leaking from multiple sources, not just anonymous social media accounts. None of that happened. Now, I want to be fair here. The rumor isn't entirely fabricated from nothing. There's a kernel of truth that probably sparked this whole thing. The Federal Reserve's H4.1 release. That's a weekly report on the Fed's balance sheet. Showed something interesting for the week ending December 24th. Primary credit borrowing, also known as discount window borrowing, rose to over $9.8 billion. The discount window is the Fed's lender of last resort facility. Banks can borrow directly from the Fed, but they pay a penalty rate and there's a stigma attached. Going to the discount window is like showing up to a potluck with store-bought cookies and the price tag's still on. Everyone notices, including your cat. You only do it if you have no other choice. A rise to nearly $10 billion is notable. During quiet times, this number is basically zero. So something was going on. But, and this is important, during the 2023 regional banking crisis, when Silicon Valley Bank and others were actually failing, this number spiked to over $150 billion. During 2008, it was similarly massive. $10 billion suggests liquidity tightness, not solvency crisis. And this difference matters. I've talked about it several times in some of the previous videos, but allow me to explain again. Liquidity tightness means I have good assets, they're worth money, but I need cash right now and the market is closed or too expensive. This is a timing problem, not a value problem. Solvency failure means my assets are worth less than what I owe. That's an existential problem. That's when banks actually collapse. The 10 billion figure fits the year-end liquidity squeeze pattern. It does not fit the systemically important bank about to default on a massive derivatives position pattern. If that were happening, we'd be looking at numbers in the hundreds of billions. So yes, the banking system was a bit constipated. But it wasn't dying. Let me put this all together and show you how this narrative probably formed. It's actually a really useful case study in how market folklore gets created. There's a psychological phenomenon called apophenia, the tendency to perceive meaningful connections between unrelated things. Humans are pattern recognition machines. Sometimes we see patterns that aren't there. Here's the sequence. 1. The environment. It's year-end. Markets are thin. Liquidity is naturally lower. Everyone's on edge. 2. The event. Silver crashes. Traders who are long lose serious money. They want an explanation. Better yet, they want a villain. 3. The coincidence. On the same day silver crashes because of the CME margin hike, the Fed publishes data showing elevated repo activity because of year-end seasonality. 4. The connection. Someone links these two unrelated events. The Fed is printing money to save the bank that caused the silver crash. 5. The exaggeration. The numbers get inflated. 26 billion becomes 34 billion. The timing gets dramatized. Monday becomes Sunday emergency. The causation gets reversed. The margin hike liquidating longs becomes a bank failing on shorts. And suddenly you have a viral narrative that feels true because it connects real events, even though the connections are imaginary. So where does this leave us? The specific rumor, a bank failure, a Sunday bailout, appears to be market folklore, a dramatic story constructed to explain a painful event. But the underlying data does show a system that's liquidity constrained. The plumbing is tighter than ideal. The Fed is doing more work to keep money flowing than it would in a truly healthy market. Is this a crisis? No. Is it worth monitoring? Absolutely. Here's what I'd suggest watching if you want to stay ahead of this. The H4.1 release comes out every Thursday. Check the discount window borrowing number. Scenario A. Normalization. If that number drops back towards zero in the first few weeks of January 2026 and repo volumes fade, then this was just the usual year-end squeeze. Textbook seasonality, nothing more. Scenario B. Escalation. If discount window borrowing stays above 10 billion or climbs higher after the year-end effects should have faded, that's a different story. That would suggest something structural, not seasonal. That would warrant real concern. The data will tell us which scenario we're in. Not social media rumors, not viral threads, the actual boring, publicly available Federal Reserve data. So look, here's the bottom line. The silver crash was structural, not systemic. A margin hike flushed out over-leveraged longs. That's it. The secret bailout doesn't exist in any Fed record. The actual operations were normal year-end liquidity management. There are real signs of tightness in the banking system, but they're consistent with seasonal patterns, not imminent collapse. If you made it this far, thank you. Genuinely. I know 10 minutes is a lot to ask when there are infinite cat videos competing for your attention. Speaking of which, I should probably post more actual cat content. Rebrand the whole thing. DataCat explains finance while his cat ignores him. Could work. But if you found this useful, if breaking down the actual data helped you see through the noise, consider subscribing. I'm not selling a course. I'm not going to pitch you anything. I just want to help people think more clearly about markets, using the same analytical approach I used in my corporate days, except now without the soul-crushing bureaucracy. Hit the like button if you're feeling generous. It helps the algorithm, and honestly, it helps me feel like I'm not just talking to myself in a room full of keyboards and cat hair. Anyways, remember, stay curious and skeptical, verify the data, and maybe keep some extra cash on hand in case the CME decides to change the rules on you. Alright, DataCat out, and I'll see you in the next one.